This is Marcus, and he's got a huge problem. 6 months ago, Marcus stood in front of a federal judge and watched $340,000 of debt disappear. Gone. Wiped clean. On paper, Marcus should feel like a man who just got his life back. Instead, he's sitting in his car in a parking lot, staring at a rejection email for an apartment he can easily afford, wondering why fixing his finances feels like it broke something else entirely. He's not behind on rent, he's not overdrawn. His paycheck clears every 2 weeks like clockwork. And yet, a leasing office that runs a standard background check just turned him down for a one-bedroom that costs less than what he used to pay in minimum credit card payments alone. Somewhere between the courtroom and this parking lot, debt-free quietly turned into unrentable. And nobody warned him that was part of the deal. Here's the number everyone fixates on when they hear the word bankruptcy: the discharge amount, $340,000. That's the headline. That's the number that makes bankruptcy sound like a cheat code. Rack up debt, file some paperwork, watch it vanish. And if you stop the story there, it looks like Marcus won. He owed a fortune, and now he owes nothing. But that number is the least interesting thing about what happened to Marcus, because it's also the most misleading. Bankruptcy doesn't make debt disappear. It relocates it. It takes a number that was sitting on Marcus's shoulders and breaks it into smaller, quieter costs that don't show up on any court document. And those costs start leaking out the moment the ink dries. The first leak is the credit score, and this is the one people expect. Marcus's score dropped from the low 600s to the low 400s overnight. What people don't expect is how long that number stays broken. A Chapter 7 filing sits on a credit report for 10 years. Not 10 months, 10 years. For a decade, every landlord, every lender, every leasing agent for a car, every utility company running a soft check before turning on the electricity sees the word bankruptcy attached to Marcus's name. Some of them will work with him anyway, at a price. His car insurance premium went up almost 30% at renewal because insurers in most states are legally allowed to price risk using credit-based scores, and a bankruptcy reads as risk. The apartment he eventually did get required a security deposit, triple the standard rate, plus a cosigner. The debt didn't vanish, and it turned into a surcharge on every future transaction Marcus makes for the next 10 years of his life. Quietly billed in the form of higher rates and bigger deposits instead of one lump sum. The second leak is the one nobody warns you about until you're standing in it. Not all debt actually dies in bankruptcy. Marcus's credit card balances, his medical bills, his personal loans. Those discharged, but he still owes $41,000 in student loans because those almost never get discharged, bankruptcy or not, short of a separate and brutally difficult legal, showing that most filers never even attempt. He still owes back taxes from 2 years ago because recent tax debt usually survives the process too. If he owed child support or alimony, that would have survived untouched as well. So would most criminal fines. And so would any debt a judge decided he racked up through fraud. So the $340,000 gone headline was never the full picture. Marcus walked out of that courtroom with the loud debts erased and the quiet, stubborn ones still fully intact, still collecting interest, still due, still following him into the fresh start. The process was supposed to hand him. The third leak is the process itself, and this is the part that feels almost insulting once you understand it. Getting out of debt costs money. Marcus paid a bankruptcy attorney $2,200 to file. He paid court filing fees on top of that. He paid for a mandatory credit counseling course before he was even allowed to file, and a second mandatory course afterward before his discharge could be finalized. 2 separate classes the government requires you to take and pay for to prove you understand money, sandwiched around a process that already proves you're in crisis over money. And Marcus's case wasn't even the more expensive kind. If his income had landed him in Chapter 13 instead of Chapter 7, a repayment plan instead of a full discharge, he'd have been locked into 3 to 5 years of court-supervised payments, with a trustee taking a percentage cut of every dollar that passed through the plan before it ever reached a single creditor. People sometimes pay thousands of dollars in trustee fees over the life of a Chapter 13 plan, on top of the debt they're repaying, just for the plan to exist. Then there's the fourth leak, the one that doesn't show up in any dollar figure at all, the asset test. Before Marcus's debts were discharged, the court looked at everything he owned. His retirement account was protected. Wait, most states shield those. His car was fine. It fell under an exemption too. But his small collection of vintage tools, inherited from his father, sat right at the edge of the state exemption limit, and for 3 weeks Marcus didn't know if he'd be allowed to keep them, or if the trustee would seize and auction them off to pay creditors pennies on the dollar. He sat through something called a 3-for-1 meeting, a formal hearing where a trustee and sometimes his creditors can question him under oath about everything he owns. He kept the tools, barely, after his attorney argued the appraisal down. Plenty of people in his position don't. Homes above the state's homestead exemption, second vehicles, valuable collections, even a modest inheritance received soon after filing. All of it can be exposed to seizure, and the anxiety of not knowing which of your possessions counts as yours versus collateral for strangers is its own quiet cost that never appears on a single form. And underneath all of it, there's a fifth cost that doesn't have a line item because it's not financial, it's social. Marcus hasn't told his parents. He told his brother, and only because his brother co-signed a car loan years ago and needed to know his own credit wasn't at risk. Bankruptcy carries a shame most people don't carry for divorce, for job loss, for almost anything else that happens to a person's finances. Some employers, particularly in finance, government, or roles requiring a security clearance, are legally allowed to ask about it or factor it into a hiring decision. Marcus isn't hiding a crime. He's hiding a legal process specifically designed by the federal government to give people a second chance. And he's hiding it anyway because the paperwork erased a debt but did nothing to erase the stigma sitting on top of it. Before any of that, Marcus had to prove he even qualified for the version of bankruptcy he wanted. Chapter 7, the kind that wipes out most debt outright, isn't available just because someone asks for it. There's a means test, a federal formula, that compares an applicant's income against the median for their state and household size. Earn too much, and the law assumes you can afford to pay some of it back, which pushes you into the slower, supervised fee-bearing version instead. Marcus qualified for Chapter 7 because his income had dropped after a layoff the year before. If that layoff had happened 8 months later, or if his severance had landed in the wrong tax quarter, he might have spent the next 5 years under a trustee's supervision instead of 6 months. So add it up. The credit damage that taxes every purchase for a decade. The debts that survive the process untouched, still due, still growing. The fees required just to access the relief in the first place, on top of a formula that might not even let you access the cheaper version of that relief. The risk of losing property you already own. Decided by a trustee in a state exemption table. The isolation of carrying a stigma in silence, even from your own family. None of that is on the court order. All of it is the actual price of the clean slate. And almost none of it was visible to Marcus before he signed the paperwork that started the process. Now here's Julian, because Marcus's story alone could be read as one unlucky guy who happened to get a rough draw. It isn't. It's the standard shape of the thing. Julian ran a small landscaping business for 11 years, 14 employees at his peak, a fleet of trucks, a name people in his town actually recognized. When a client went under, owing him $60,000 on a commercial contract and diesel prices spiked the same quarter, Julian's business folded within 8 months. He filed Chapter 7, but not just for the business. For himself, personally, because he'd signed personal guarantees on the equipment loans years earlier. The truck, the mowers, the trailer, all financed under his own name, not the company's. The way lenders almost always insist on for a business without decades of credit history behind it. That's the detail most people miss about small business bankruptcy. There often isn't a wall between the business's debt and your debt. When a small business fails, the owner frequently fails with it, on paper, personally, for a decade. Julian's discharge number was smaller than Marcus's, about $92,000, but his leaks were faster and meaner. He lost the truck and the mowers in the process, which meant he lost the actual tools required to start over in the same trade, even if he'd wanted to rebuild from scratch. He lost 14 jobs that weren't his to lose alone, 14 other households that had to scramble for new work the same month his life fell apart. A cost that never once appears in any accounting of what bankruptcy took from Julian, because it wasn't taken from Julian at all. And because commercial credit checks are brutal, Julian couldn't get so much as a fuel card for a new venture for years afterward, not without a cosigner, not without paying double the going rate in fees and deposits on the rare occasion anyone would extend credit to him at all. Same shape as Marcus, surface number, hidden survivors, mandatory costs to access relief, assets on the line, quiet social cost nobody puts in a spreadsheet. Two completely different lives, a salaried guy drowning in medical bills and credit cards, and a business owner buried by one bad contract and a fuel spike. And the exact same 5 leaks drained both of them the same way. And here's the twist, because once you see this pattern repeat itself that cleanly across two unrelated people, you start to realize the popular idea of bankruptcy is backwards. It's not that bankruptcy erases a person's debt, it's that bankruptcy reroutes it. The $340,000 Marcus owed didn't get destroyed by that judge's signature. Some of it got absorbed by the credit card companies and hospitals who wrote it off as a loss on their own books, and then priced that expected loss back into the interest rates and fees charged to every other customer they have, including people who've never missed a payment in their lives. Some of it got converted into Marcus's own future cost of borrowing, a tax he'll quietly pay for 10 years in the form of higher rates and bigger deposits. Some of it got paid in cash up front, in legal and filing and counseling fees, just for the privilege of walking through the process at all. Economists have a name for this kind of loss. The cost that gets created by the process of moving money around rather than by the original debt itself. Deadweight loss. The attorney's fee, the counseling course, the trustee's cut, the depressed auction price on a repossessed truck. None of that money goes to erase what Marcus or Julian owed. It just evaporates in transit. A toll charged by the machinery built to move the debt from one place to another. Bankruptcy isn't a debt deletion button, it's a debt redistribution system. It takes an amount that was concentrated and unbearable for one person and spreads it thin across lenders who eat the loss and pass a slice of it on to everyone else who borrows, across the filer's own next decade of financial life, across the fee-based professionals who run the process, across the family members who quietly absorb the emotional weight because they're the only ones who know. The number on the court document was never the cost. The number on the court document was just where the cost started, the moment it stopped being one lump sum and became a decade of smaller ones. Which brings us back to Marcus, sitting in his car in that parking lot with a rejection email open on his phone. He isn't upset because bankruptcy failed him. In the strict legal sense, it worked exactly as designed. The debt he legally owed is gone, and that's not nothing. What's actually sitting on his chest is the gap between what he was told bankruptcy would feel like and what it actually costs to walk through it. 10 years of financial suspicion built into every rate he's quoted, a stack of debts that never left in the first place, a bill just to file for relief from other bills, a scare over whether he'd keep his father's tools, and a secret he's still keeping from his own parents. 6 months later, sitting in a parking lot. Bankruptcy isn't the end of a financial story. It's a rerouting, a way of taking one unbearable number and turning it into a longer, quieter, more distributed one that's easier for the system to absorb, but harder for the person to see. It doesn't erase the cost of the mistake, the accident, or the bad luck that got someone there in the first place. It just changes who pays it, when they pay it, and how visible that payment is to everyone else looking in from the outside. Marcus will be fine eventually. In a decade, that 10-year mark clears off his credit report, and on paper at least, the system finally forgets. But it's worth sitting with the fact that eventually is doing a lot of work in that sentence. And that the process built specifically to give people a second chance is also quietly one of the most expensive and least understood things a person can go through to actually get one. If this is the kind of thing you want broken down, the real, unglamorous mechanics behind the financial moments people usually only ever see the headline number of, that's what this channel does. Subscribe if you want more of it.